Friends, thank you for being here today. What if I told you that $600 billion could disappear almost instantly? What if I told you that a 158-year-old financial titan, a firm that survived the Civil War, the Great Depression, and 2 world wars collapsed in a single weekend? On the morning of September 15, 2008, the global financial system stood at the edge of a cliff. In the early hours of that Monday, Lehman Brothers filed for Chapter 11 bankruptcy in the Southern District of New York. This wasn't just a company failure. It was the implosion of an institution many believed was too large, too old, too woven into global finance to ever fall. Yet it did, becoming the largest bankruptcy in U.S. history. At the moment of collapse, Lehman listed assets between $639 and $691 billion, against $613 billion in debt. These weren't just numbers on a balance sheet. When a financial body of that size collapses, the shock waves don't stop at Wall Street, they crash straight into Main Street. Retirement savings evaporated. Credit markets froze. A global recession ignited. On the day of the filing, the Dow Jones plunged 500 points, its worst fall in 5 years. But that was only the visible part. Behind the scenes, the gears of the global credit system seized. Banks stopped lending. Fear replaced trust. And the myth of too big to fail dissolved overnight. To understand the collapse, we must start at the beginning. In 1844, a 23-year-old German immigrant named Henry Lehman opened a small dry goods store in Montgomery, Alabama. Soon joined by his brothers Emmanuel and Maya, the business became Lehman Brothers. Cotton dominated the Southern economy. Customers often paid with raw cotton rather than cash. The brothers adapted. They accepted cotton as payment, traded it, and soon moved from selling goods to dealing in commodities. By 1858, the firm had opened an office in New York City, diving into the bustling world of transatlantic trade. After the Civil War devastated the South, this move proved life-saving. Lehman helped found the New York Cotton Exchange, marking its evolution from merchants into financial intermediaries. Over the decades, Lehman shifted from commodities to investment banking. Under Philip Lehman, they underwrote IPOs for giants like Sears, Macy's, F.W. Woolworth, and even Hollywood studios like Paramount and 20th Century Fox. During the Great Depression, while traditional lending collapsed, Lehman helped pioneer venture capital, turning crisis into opportunity. But success has a shadow. By the 1970s and 1980s, Lehman was known for chaos, infighting, and a ruthlessly competitive culture. Some called the trading floor the devil's casino. Tensions eventually pushed the firm into the arms of American Express in 1984. The cultures clashed. It was a marriage of necessity, not harmony. In 1994, Lehman regained independence, and at the center of the new era stood a man whose leadership would make and break the firm. Richard Dick Fuld, nicknamed the Gorilla. Fuld was loyal, aggressive, and combative. To him, banking was war. He demanded total devotion and paid employees heavily in restricted stock. It was meant to align interests, but it left thousands financially chained to the firm's fate, including Fuld himself. Despite this, under his leadership, Lehman thrived through crises like the dot-com crash and 9/11s. The firm rebuilt operations within days after their headquarters near the Twin Towers was destroyed. This resilience fed a dangerous myth: we are untouchable. Lehman expanded aggressively into proprietary trading, private equity, and most fatefully, mortgage-backed securities. In 2007, the firm posted record profits and a soaring stock price of $86. They looked unstoppable while standing on a ticking time bomb. After the dot-com crash and 9/11s, interest rates were slashed to 1%, unleashing cheap credit. Housing boomed. Wall Street fed the frenzy through securitization, turning mortgages into MBS and CDOs. When banks ran out of good borrowers, they turned to risky ones. Enter the era of subprime mortgages, including the infamous NINJA loans. No income, no job, no assets. Lehman didn't just buy these loans, they acquired lenders like BNC Mortgage, giving them a pipeline of risky mortgages to package and sell. Their fatal flaw: leverage for every $1 of real equity. Lehman borrowed $30. That 30-to-1 ratio meant even a small decline in asset values could wipe them out. And that is exactly what happened. Lehman's toxic financial products reached far beyond the US, especially into Asia. In Singapore, they sold structured products like mini-bonds and high notes, marketed as safe investments for everyday savers. In reality, these products made investors effectively the insurer for Lehman's risky derivatives. When Lehman fell, these investors, many retirees, lost everything. One man, Mr. Tan, lost his life savings and later suffered a heart attack from the stress. Thousands more were affected, sparking protests and regulatory reform. The downward spiral began in June 2008, when Lehman reported a $2.8 billion loss. Panic spread. The stock plummeted. Fooled, unwilling to recognize reality, blamed short sellers instead of acknowledging the toxicity in the firm's books. By September, the situation was catastrophic. Lehman's stock collapsed 48% in a week. Banks stopped trading with them. Electronic withdrawals surged. On the weekend of September 12th to 14th, government officials pushed Wall Street executives to find a rescue. Bank of America walked away. Barclays wanted a deal, but British regulators blocked it. With no savior, the board voted for bankruptcy. On Monday morning, Lehman Brothers was gone. The consequences were immediate. The reserve primary fund broke the buck, causing money market panic. Corporations struggled to raise cash for daily operations. Global credit froze. Stock markets crashed worldwide. The world entered the deepest recession since the Great Depression, a strange twist in London. Lehman's European arm entered administration under PwC. At first, creditors expected pennies on the dollar, but as markets recovered, so did the value of the asset. More than a decade later, something extraordinary happened. Creditors were repaid 100% plus 40% interest, one of the most improbable turnarounds in financial history. Numbers alone didn't collapse Lehman Brothers. Human flaws did. Hubris, believing disaster was impossible; confirmation bias, ignoring warnings; groupthink, silencing dissent; moral detachment, treating billions like mere digits; greed, chasing profits at any risk; and ultimately, everyday employees, loyal for decades, walked out carrying cardboard boxes and worthless stock. Regulators tightened rules. Banks now hold more capital and prepare living wills for orderly failure. That remains unresolved. Dick Gould earned $480 million before the collapse. No prison, no real consequences, as some critics put it. Profits were privatized. Losses were socialized. Lehman Brothers stood for 158 years. It vanished in a single weekend. The real question isn't whether Lehman could have been saved. The question is whether we, collectively, will learn from it. Because history shows a troubling pattern. When fear fades, risk returns. When memories fade, leverage grows. And when greed resurfaces, crisis follows. So I leave you with this. When the next bubble inflates, will we remember, or will we repeat the cycle all over again?